So now I'll talk a few tips specifically for those who buying a block of land and want to subdivide and build, 2-3 townhouses. So there was a few in the room, so yep. So these are directly to you. So I'm trying to help everyone out. So some tips that I can give is obviously of a general nature. So disclaimer, everything is of a general nature. Before you do anything, please speak to your tax accountant, speak to me to get advice. So a lot of people to start off with, might have, okay, they've got a block of land, mainly their main residence, if you bought it ages ago. You might have a nice block of land, 800 squares, you've got your main residence at the front, and you're thinking, great, I've got a nice block of land, I'm going to subdivide and build one at the back. Now, as we know, everyone gets one main house, one residential house for free, tax-free, one house. Everyone in Australia, if you're Australian resident, yeah. So if this is your land size and this is your house and you've been living in it for, and you bought it after 1985, and you sold it, that would be tax-free. But then if you come around and say, nah, I've got a nice block of land, I'm going to subdivide it, get its own title, yeah? What essentially you've done is, well, that second dwelling is no longer your main residence. When you sell your main residence, you still get the exemption, but the second dwelling is no longer your main residence because it has its own title, everything. So, what you need to do is you'll get a market valuation at the date when you subdivide, and that will value the land of the second dwelling. And then when you do sell, eventually, that will be your cost base of the land. So essentially, you've potentially lost some of that main residence exception because that is no longer your land. That belongs to that second dwelling. So obviously, with the aim, when you do sell, you're going to make heaps of money, so that should offset that. So you need to keep that into consideration as well, okay? So be careful when you do subdivide your main residence, whether it does jeopardize the characterization of the exemption of your main residence.
What would happen if you were to go ahead and sell your main residence and then move into the back property? Then
immediately?
Yeah, well, once you've sold the front property, yeah.
You've got a 6-month window where you can have 2 main residences for 6 months only. So I'll need to be looking at timing. I'll need to look at your intent when you built it. If you had the intent to sell it for a profit, then there is a section that overrides. So it all comes to your intent, your purpose. And that's easily established when you obviously get your, when you do your permits, when you're doing all the council paperwork, all that's obviously documented and that's like normally a year in advance, right? You can't just go, oh, hang on, yeah, I might just sell that one and live here. So it's all about planning, like anything. Planning, preparation, you got to get the right advice at day one before you even start building, right? It's too late once you've already built. I mean, you can, but obviously it's not as easy. It's always best to know what you're doing, get the right advice at day one, and then you can then obviously do what's best for you and your family. Any other questions?
Just a quick question.
Yeah.
So if you sell one of the subdivided properties, can you reinvest that capital back into another property?
So was the original piece of land your main residence, or was that just completely
just say it's
investment?
you've subdivided it, you put an extra townhouse on one. If you sold that, can you take that cash and reinvest it before being taxed, or how does that work?
No, so when you do sell, so if it was always your investment property and you sold it and you sold the unit for profit, you need to pay tax on the profit, on the profit. And whether you get 50% CGT depends on your structure, if it's companies, through the structure. So yeah, you have to pay tax on your profit.
So is there a way around it? That's the question.
I'll need to, not in this forum, need more details, again, need to know your intent, need to look at your whole financial structure, yeah? Like with anything, with finances, it's not a yes-no answer. These are just guidelines and things that you need to consider. And then when we have a more detailed, tailored advice, because I don't know anything about, you know, your particular situation, so there might be a different way that might be more beneficial to you that we don't know yet because we don't know your situation. Yeah, but you know, there are a lot of, and tax is always changing. So you know, with the federal budget, they change things. Who knows what in 5 years' time? So tax is always death and taxes. Yeah, definitely. That's one of the considerations when you're making investments and things like that. But in 10 years' time, who knows what the tax system will look like? You know, for those who follow tax a little bit, superannuation in last year's, this year's budget, they were tweaking around superannuations. For those a bit older, they're tweaking around the superannuations, so that got passed. So in 10 years' time, who knows? They might tweak negative gearing. They might tweak GST. You know, there's talks around already. So all you can do is do what's right for you, your personal situation, and tax. Yeah, of course there's benefits, but you do that as a secondary measure because yeah, tax law can change. Okay, all right. Thank you everyone for your questions.
Just coming to something you've said earlier.
Yeah.
You know how you had the personal company and the trust breakdown?
Yeah.
I think it would be really good if you had graphed that, because then you can plot it 5, 10, 15, 25 years, so that there's a vision forward on how best to run with it and what can be done to tweak it, whether family members come in and siblings and things like that. So that's what I see valuable for people that are looking to move into that area seriously.
Okay, yeah, absolutely. Like, and people's situations change as well. Like, a lot of people, you know, might start with the one investment property and therefore they put in their name to do the negative gearing, because you can do the cash flow or the positive or negative.
What I'm actually asking is, do you have something like that to put forth?
I don't have it here, but that's more advice tailored towards, say, your particular needs, and therefore would have one-on-one conversations.
Okay.
Yeah, rather than, you know, obviously the general. So I have a feedback form at the back of feedback form. So at the end of the session, I would really appreciate if you could fill out the feedback form. That way, you know, I can obviously improve what worked well, what didn't work well. You can write any other questions that you might come up with, and if you've got your contact details there, I'll try and answer it as well. So yeah, please fill out the feedback form.
Can I just ask one question?
Yeah,
too?
sure.
If you're living in your principal place of residence and then you're going to rent it out, so you move to another property, I've had contrary advice. Do you value it as, like, you get a true valuation to say this is my, you know, tax-free portion of it, or do you then actually have to wait till you actually sell it and then just pro-rata it as per the years that you owned it?
Okay, so you say you lived in your house for 10 years, you then rent it out and you live somewhere else. So what you do, say you rent it for 5 years and you live for 10, and so you got a total of 15 years, and it was after the 1985 date. That's a special date for us. So that's effectively 1/3 is
So
taxable.
It is prorated.
It's prorated.
Nothing to do with the value at the point.
Yeah, it's prorated, so that's point 1, prorated.
Yeah.
However, at that point in time, so say today you're moving out, you need to get a proper valuation to determine what was the market value of that as well.
So that's to me contrary. You can either do one or the other. Do you then choose which one you want to use?
No, you don't. You don't have. There's no choice. So you get the market valuation at that day. So say it's valued at what, $500,000. So you probably bought it for $200. It's $500,000. That is your cost base. Then when you sell it for $700,000, that's a $200,000 gain. If it's under your name, you get the 50% discount, subject to obviously certain tests. They're running through the test, but subject you do get it. That's $100,000 profit, and then you pay at your marginal rate.
So where does the 2/3 that I lived in it and 1/3 that I didn't, where does that come into?
Because some people don't get a valuation on the actual day, when that is the best way to get the valuation at the day, but a lot of people don't know. So secondary, the ATO may, up to their discretion, may take that a proportional
So
basis.
literally both processes are possible, but you would be better.
Possible, correct, possible, but definitely
Yeah.
do the correct way.
Because it depends on where the property value's gone up. Like
Correct.
it might have gone up a huge amount when you were living in it, which is what you want.
Yeah.
but it might be the other way too. So can you get the valuation, then when you sell it, kind of go, I prefer it prorated, I'll just pretend.
No,
I didn't get
the
valuation.
HOA, you should do what the HOA way is. That's their preferred way, because they can reject the second way rate. That's not an approved way. They haven't signed off on that. That's just okay. Well, we didn't know, etc., etc. You then do a not a ruling, but you apply for it. They can say yes or no.
Yep.
So it's a bit more risky. They might say yes, they might say no,
So
but
bottom line valuation.
valuation. And you need to get a proper valuation. Don't just go get a real estate. We think it's $700. Get a qualified valuation. Yeah.
Thank you.
That works. Okay. All right. Thanks, guys.
Thank you, May.